Good morning, everyone, and thanks for the warm welcome, Nick. Now, my name is Grady Wulff, as Nick said, and I'm very fortunate to be the market analyst at Bell Direct and in the Bell Financial Group, which is a really exciting time, and as I'm sure you're all aware, it's a very volatile time in the markets. So what better way to keep on top of the markets than being the market analyst with such a reputable company? Now, before I start, I just have to tick this off so legal doesn't tell me off when I get back to Sydney. Anything I say today is simply information only and not advice. If you would like to invest in any of the stocks that I mentioned today, you need to do your own research. Unfortunately, I have picked stocks that aren't here so as not to be biased to any of the companies, but if you have any further questions about the research that I provide, we'll be at the stand over the next 2 days. So Bell Direct, what is Bell Direct? It's an online trading platform that aims to make your life as an investor as simple, intuitive, and easy as possible. And we provide all of the insights for new investors to understand the ground rules of fundamentals of market investing. And for those who are experienced, it's about honing in and understanding the short and long-term goals of investing and finding the little gaps in the market where you can find the best investment opportunities. So I thought today we'd start pretty broad and look at the markets from a 10-year basis. Now, this chart shows that markets over time, the one thing, if you take away one thing today, markets over time do go up. There is noise and there is events in the market that will affect the markets, but sticking to your long-term goal is very, very important. Now, what you can see here is the US up the top in the orange, followed by China below that, in the black. Light grey is Europe, and Australia at the bottom in the dark grey. Now, what we can see is a few key peaks and subsequent sell-offs in the market. So first one being December 2018, when the S&P 500 fell 9% in 1 month because of China's trade war with the US and fears of monetary tightening policy in the US. And then again in March 2020, we had this weird thing called COVID turn our lives upside down. And again, markets were sold off because we were plunged into lockdown. Nobody knew what the future looked like. Were we going to be in lockdown forever? Who knew? But again, the subsequent rise was phenomenal. Governments were handing out money left, right and centre. Interest rates are at a record low 0.1% in Australia. And where else do you spend this money than on activewear or in the stock markets? So we saw the markets go back up. And then again last year when Russia devastatingly invaded Ukraine, again this caused an energy crisis like we've never seen before, but markets have now factored these into commodity prices, and as a result we have the markets going back up. Now, when I'm assessing the markets, I am always asked, when is this inevitable market correction coming? If I had a crystal ball, I could very easily answer this for you, but unfortunately I do not have a crystal ball, I'm not psychic. And in order to answer this question, you can't really predict when it's coming, but keeping an eye on certain macro events every single day and week is really important in this market environment. So what I look at is OPEC Plus and oil prices. So China coming back online this year has happened at a much slower pace than was first predicted. Everyone thought China coming out of lockdown, they'd come back at 1 million miles an hour and all will be well again. But unfortunately, they've come back at a really slow rate. That's caused an impact on commodity prices, and the latest on the chopping block has been iron ore. Now, steelmakers in China and authorities are saying to steelmakers, cut output. Domestic steel prices are at a really low at the moment, so we need to cut output. That's impacting our big iron ore miners here, and we're having pile-ups of iron ore at the ports that are output to China. So again, on the last week, we've seen the iron ore price drop. Oil had the same problem at the start of last year. It went to record highs because of Russia's invasion of Ukraine. This year, again, China is the world's second largest importer of oil. Again, oil prices plunged, so that caused OPEC Plus to cut output by 1 million barrels per day. And then we have recession fears, which is factored in at 75% chance the US will head into a recession at the end of this year. We have interest rates heading towards the end of a monetary tightening policy, which causes, again, a bit of stress in the market. And now, even this morning, I saw on the news that it's expected the RBA will raise by a further 25 basis points in June and July. So we're in for a little bit tougher times. Not to say that it's going to happen, but that is the expectation right now. So overall, when investing in the markets, the one nice thing that you can take away from this is markets do go up over time, but there is a lot of news and noise that you need to consider when investing. So let's have a look at I'll break it down in sectors. Now, this is probably my favourite chart in all of the charts that I analyse. In sectors in the ASX over the last 10 years, and it's a very surprising chart. So stay with me, I know it's really, really messy, but the first 4 years, we can say that all of the sectors moved pretty well in unison. They all went pretty well, except for the ones that underperformed the market, but generally they all moved in the same direction. And then we have, after that, a number of macroeconomic events that impacted different sectors in vastly different ways. Who would have thought the healthcare sector has outperformed the market over the last 10 years? Because I certainly would not have thought that. With the length of time it takes for these companies to get into revenue and earnings. So for a typical healthcare company, it can be up to 10 years. From the day they find a drug they think is going to be able to treat or cure a disease or a disorder, to the day that they get commercialisation and their first sale. It can be 10 years. The thing about the healthcare sector is it was the only sector to go up during COVID-19. Now, with that in mind, a lot of companies, the reason this is so, is a lot of companies stopped what they were doing right then and there and said, let's come up with this vaccine to cure the COVID-19 and return life to normal as we know it. And after that, investors went, oh, these companies can move pretty quickly if they want to, but they also can prioritise different areas. The TGA, FDA and other regulatory bodies are really prioritising, which in 2023 we're seeing as cancer imaging and Alzheimer's. So a number of companies on the ASX, so Telix Pharmaceuticals is one, they have a prostate and kidney cancer imaging agent. They have soared over the last few weeks and months, and I've been kicking myself ever since because I've been talking about them since December. And for that reason, we're seeing a lot of appetite for healthcare stocks in 2023. Just below that sector, we have the tech sector, which, as you know, is highly volatile. It was the sector to be in 2020 and the sector to get out of last year. This is because it rides on interest rates. Now, these companies have really high growth outlook, really high, they say they're going to be profitable, but until they are profitable, there's no value in them and for an investor. So these companies were like the Afterpays of the world, the Zipcos, the Sezzles, all the buy now, pay later companies. And then in 2022, when interest rates started rising, funding growth outlook became really expensive with every single rate hike. Investors saw no value in the sector, aside from companies that had free cash flow, had really strong revenues, and annual recurring revenue is a key factor when investing in the technology space. We want to see that they can weather the storms of economic events, so annual recurring revenue is a key factor of the tech sector. And then below that, we have consumer discretionary, which remains pretty strong and resilient in the last few years. But at the bottom, we have the energy sector. Who would have thought that the sector to be in 2022 is the sector that underperforms the market over the last 10 years? I wouldn't have thought that in a million years. But it goes to show, when you're investing, you do need to look at the different sectors and their performance in order to make the best and most informed sector decisions and investment decisions moving forward. Now, without further ado, I'll dive into the stocks that Bell Potter is bullish on in the materials and energy space moving forward. None of them are represented here because, again, as I said at the start of the presentation, I did not want to be biased to anyone in the room, but any questions about some of the stocks that are here that we do cover, I can give you the research overview at the stand, the Bell Direct stand over the next few days. So, in the materials sector, Gold Road Resources. I'm sure some of you have heard about Gold Road Resources in the past few weeks. It is a really strong top-tier company in a top-tier mining jurisdiction of WA, and that is why Bell Potter are really bullish on this company over the next few years. Now, they had record cash flow, good cash flow in the first quarter of FY23. They have really good diversification over a number of mines. So they have a 19.99% stake in De Grey Mining, which Bell Potter has a spec buy rating on De Grey Mining. They also have they're obviously producing gold at the Gruyere Gold Mine project. And despite lower head grade in recent times, their all-in sustaining costs came in below Bell Potter expectations. And that's one reason we're really bullish on Gold Road Resources at the moment. They also have a joint venture with Goldfields on the Gruyere project, and that the first gold was produced in June 2019. So understanding that and understanding how much, as I think we were saying last night, Headley Dave was saying that the gold was the sector kind of to be out of last year, and this year it is the sector to be into because of such uncertainty in the market. And we're seeing at the moment with a lot of our investors, because at Bell Direct we have every day we have gold. We have top 10 traded stocks of our clients that day. Gold Road Resources and a lot of gold miners are often featured in there because we're seeing a lot of appetite in gold as a safe haven to bolster your portfolio in this current market environment. Now, the second stock I have in this materials space is Mincor Resources. Now, as I'm sure you're all sitting there thinking, oh, it's under takeover at the moment by Wyloo and Andrew Forrest. That is correct, but in Bell Potter's point of view, if you are one of those shareholders that currently hold Mincor, it is a hold rating at the moment, just because at the moment, as you know, all of the takeover offer is being accepted and underway. But the thing to keep in mind about Mincor over the next few years is they do have that offtake agreement with the nickel offtake agreement with BHP. And understanding that they had some grade quality issues with BHP. So delivering that has been a bit tough. They have a set amount they have to deliver, and unfortunately that has met the grade they're required to deliver has fallen short of what they've needed for BHP. So keeping that in mind, they have accepted the $1.40 takeover offer, and the share price at that time was around $1.56. So with that in mind, keep on, it's a hold rating on Mincor Resources at the moment while the takeover offer is being completed. Next up, this one is a really, really exciting space for us. Now, there's one space that I didn't really talk much about in 2022, the rare earth space. Now, in recent times, we have seen a big sell-off and a come down in the price of NdPr. I'm not even going to try and pronounce NdPr for all of you. That is the key rare earth that some of our producers are looking for and mining for. Yeah, any miner here that can pronounce NdPr, feel free to come up and talk about it. But NdPr is how it's known at Bell Potter and Bell Direct. Now, Lynas Rare Earths is a key pick for us. We have a buy rating on Lynas Rare Earths because of their high quality assets, and they're a key producer and provider of these rare earths to the Western world. Now, the thing to note about the NdPr price coming off is a lot of it was to do with Tesla and China. Well, Tesla, first of all, saying they're changing their batteries from including NdPr to another rare earth or another element. This caused a sell-off in the sector, but it shouldn't have had as much of an impact as it did. That is because the NdPr is used in the motors of EVs, so the demand is really up there and it's not necessarily a huge element in the batteries. So understanding that a lot of our cars and a lot of car companies in the world are transitioning to the EV movement, lithium is the word for the batteries and NdPr is included in all motors. So with that in mind, this puts Lynas in a really, really good position because they do mine for the key rare earth NdPr. Now, a lot of you might have seen in the last week, Lynas went up about 10% in one day because of their Malaysian permit being extended to the 1st of January 2024. So what this means is there was a really kind of cloud over the company, we'll say. They were going to have to shut down the Malaysian operations due to the cracking and leaching and have to move them over to Kalgoorlie in Western Australia. Now, they did get the extension of the permit. It was set to expire on June the 1st. It's now been extended to January 1st, 2024, and they're still going to fight this to continue operations there forever because of the low cost of production and the good outcome that they get from operating over there. So with that in mind, that was a headwind that we saw in the potential term. We did see that as we still had a buy rating on them despite this notion. They said it was going to be the impact of same as COVID really, but now understanding that in the last week they have got that permit extended to January 1st, 2024. That is a really key element for Lynas Rare Earths in the future. Now, the other one that we have a spec buy rating on is Arafura Rare Earths. Now, this is a really exciting one. They're not producing yet, but they're set to come online by FY25. They've just signed offtake agreements, which means they don't have to sell to the spot market, which is also another tick for Bell Potter's point of view. They've signed offtake agreements with Siemens, so a wind turbine company in Germany. They've also signed offtake agreements with Kia and Hyundai. So understanding that the company has got the offtake agreements, the de-risking done ahead of construction, which is set to start at the end of this year at the Nolans project. And the other thing that we like about this company is that Gina Reinhart recently instilled 43.7 $1.7 million as part of a capital raise into the company, a 10% stake. So she doesn't just invest in anyone, so we like the fact that she's now part of the Arafura Rare Earths story. And the final stock today that we talk about and we like the outlook of is Strike Energy. Now, the Perth Basin and gas and the operations there has been a really topical kind of area at the moment because of the interest in the space. Again, Gina Reinhardt she took over Warrego. And Warrego is the leading operator there. And Strike Energy actually has a 50% partnership with Warrego to produce the gas for them in this area, the natural gas. Now, we also had Chris Ellison vying for the Warrego takeover. Beach Energy was vying for it as well, bidding for Warrego's takeover. So it just shows how much interest there is in the Perth Basin at the moment and natural gas in this area. And the fact that this area provides a lot of the domestic gas for the shortages on the East Coast. So understanding that, the Perth Basin is a really attractive spot to operate in, and that's why Strike Energy is our pick at the moment. They aim to be Australia's lowest cost onshore gas producer in order to ensure affordable, abundant natural gas is available to support the energy transition into the future. Now, shares are up 34% over the last year and up 662% over the last 5 years, which for us is a really key sign that investors see something big with Strike Energy. Now, they operate in the Perth Basin with the West Erregulla, all these names are so big, West Erregulla part of the Perth Basin, and it's set to benefit from WA's tightening domestic gas supply and shortage at the moment that we're experiencing. They're also downstream. They're also heading into the downstream process and production of the natural gas. Now, what we see when investing in mining is the margins are made in the downstream options, especially with lithium as well. So when you're looking at those companies, if they're assessing downstream options, that's a really positive element for the companies that you're looking to invest in, as downstream is where the margins are made for most of these elements and commodities, especially in the natural gas space. Now, over the next 6 months, as Strike is transitioning, the corporate activity has released multiple independent views, and they're looking to go from mining to the production and processing. So again, this is another key transition time and very exciting time for Strike Energy at the moment. So understanding all of this, I know I've provided a lot of information about stocks we are bullish on, and why is this? Because we have a special offer for you today. So if you're looking to transition to Bell Direct or start as a new investor on Bell Direct, our marketing team have come up with an offer for you. So $500 free brokerage, which I know for a lot of people is quite a significant amount. And also, lithium is the word. So Bell Potter releases an exclusive lithium report every quarter, I think it is. And the new one is coming out next week. So we have that exclusively available for all of you today on Bell Potter's outlook for the lithium space, which is very bullish at the moment and very exciting, as I'm sure you all saw reports this week have been around the turning point is now for lithium, which puts all of our exciting lithium miners in the room in a really good position. So anyone interested in taking up this offer, please get out your phone now and hover over the QR code, or come and see our team at the stand to talk about the offer and how it will best benefit you. So without